What is the difference between a mutual fund and an ETF? From someone who has read over 50 books on finance and investment and who has been a graduate in finance from the best finance school and investing school in Australia. Now, an ETF and a mutual fund are both a fund. So, what is a fund? A fund is like a basket of investments where a group of people they put their money into a pool of funds that is used to buy a collection of assets like stocks or bonds. So, what is the purpose of a fund? Now, a fund is all about diversification. So, instead of putting all your money into just one stock, a fund spreads your money across dozens or even hundreds of companies. That way, if one stock performs badly, the others can help balance it out. In terms of history, mutual funds were created first. Now, the name comes from how it operates, right? A mutual fund is where you pool money with other people into a fund. It's a mutual effort. An ETF or exchange traded fund comes a while after as an innovative version of a mutual fund. With an ETF, you also pool money with other people into a fund, but it has a different name compared to mutual funds because of its differentiating factor, being that the fund can actually be traded on the stock exchange for how many times and whenever you want. Hence the name, exchange traded fund. And it's different from a mutual fund where you buy in and redeem directly from the fund manager and not from the stock exchange only once a day after market closes. Now, since we're reaching the more technical aspect, right? Let's get clear on when you can buy or sell these two funds. Now, mutual funds here, it only trades once a day after the market closes. ETFs, on the other hand, trades anytime the markets open on the exchange, just like Tesla or Apple. Also, mutual funds are usually actively managed by a fund manager who is trying to beat the market. However, ETFs, on the other hand, are mostly passive, tracking indices like the S&P 500. Now, let's also talk about the fees since this can be a deal breaker. Now, since mutual funds are actively managed, they usually have higher fees. Now, the higher fees you're paying is also for the manager's expertise and management of the whole fund. ETFs, on the other hand, are on the opposite side. Since it's automated tracking, ETFs has a very low fees compared to mutual funds. There's also a difference in minimum buy-in as well. Now, with mutual funds, you need around $500 to $5,000 or even more to start. But with ETFs, you can buy as little as one share, even less with fractional shares nowadays. Now, you might ask, who would buy each of them and when do you buy each of them? Well, with ETFs here, right? They are perfect if you want flexibility, lower fees, and DIY investing. However, with mutual funds, they are good if you want set and forget professional management and you don't mind the high fees. And since ETFs are significantly cheaper, they are great for regular investing and trading.